Welcome back to the Chris Barr saga. So far, we've learned who Chris is, learned what kind of businesses he's looking to buy. We've learned some strategies and some ways to get him closer to that dream. And on this episode, he gets some really exciting news, and stick around to find out what that is. Welcome back to Jackquisitions. Today we have Chris Barr back. Woo! What's going on, Chris? How you doing, man?
It has been a wild, man. Such a dynamic couple of weeks, but I mean, all good things. Love to see the traction. But how about you, man? How things been going?
We've just been busy, busy. So if you're hearing this, we are about to launch the Jackquisitions pod. So that's been busy, owned and operated. We're still recording for that. Quick Staffers is ramping up. We're placing some amazing talent, and then it's starting to get in summer. So we've sold more in like 2 days than we sold last year in like whole months. So really ramping, which has been wild. Feels good, feels great, but it's a lot. So just busy.
Heard that, man.
Just answer the phone is one of those phrases that's always easier said than done. I know it was hard for me in my business because the phone always rings while you're out in the field trying to get something done, or it's 8 p.m. and you're trying to get your kids to bed. Well, I have the solution for you. I'm extremely excited today to announce Quick Staffers, your go-to solution for building a high-performing, cost-effective customer service team. We are placing CSRs who have been pre-trained on proven home service SOPs and scripts, the same ones that Wilson and I use in our business. For a limited time, we're offering $500 off your initial placement costs for the first 10 signups. See link in the description below, or head over to quickstaffers.com for more information.
Sweet. So last we talked, you were, I think you just ran, or you were about to run a kind of a trial run walkthrough with the print shop business, I believe.
Yeah, it was an art framing business.
Okay.
So, yeah, did a walkthrough. Again, there was a lot of back and forth. The sellers, very particular about who they want to entertain as a buyer. At first told us no. We were able to get them back to the table. And then when actually, met with the owner and walked through the place. And looks like a solid, well-run business. Yeah, I'm sure it's a solid investment for someone out there. But and it's my Midwestern nature. I don't have anything bad to say about anybody. It's not personal. It just the synergy wasn't there, and the vibe just didn't feel like a fit. And it felt like, again, knowing that she was pretty specific of who she wanted as a buyer, I didn't want to go through the process, feeling like I was twisting somebody's arm the whole time. It was just not the kind of, working relationship that I wanted. So ended up actually walking away from that one. Did not even end up getting an LOI in. Just didn't feel like it fit. So it was weird to get that close on something that I liked and that I pushed so hard to get, and then ended up turning the other direction. It was a bit weird, but felt like the right decision.
Yeah, no, that is all. I always say you don't have to like your seller, but not liking your seller definitely is a red flag, right? Because it's not part of, the process to like and be best friends with this person. But specifically on this deal, there was a tie in to like you had to work for them for a certain amount of months. So that would be absolutely miserable. But on top of that, if you don't like your seller, in my opinion, neither does other people, as well as like the culture they built in their business has to function around the seller or the owner of the business's life, right? And who they are as a person. And so that reverberates through the company any way you look at it. So if it wasn't a good fit between you two, it probably wasn't a fit for the business in the long term anyway.
And I'm in no way disagreeing with you. I'm not here to offer opinions on the kind of relationships that they have with their clientele, with their employees. Yeah. It could all be a very harmonious relationship and just not a fit for me. So I'm not necessarily putting it on them, but at the same time, I do not disagree with you at all. So yeah, it just seemed like a good idea to go in a different direction. And it was also pretty outside of the sectors that I've been looking at up to this point. So yeah.
Okay. So you killed that deal, which is all part of the process, right? You killed the deal. Then you have some big news. You went after that deal that came off the market, now is back on the market. talk about that in between.
Yeah. So we got wind of this pool. It was more of a route business than the former other pool business that was more soup to nuts, full service. This one was more just kind of, route cleaning, but it was founded by this billionaire. So I've been codenaming it for NDA purposes, the Scrooge McDuck pool company. And we really didn't and that was kind of the thing is I realized as we were as we were skipping LOI, which you and I went back and forth about, that I really didn't have a ton of info on this business, not nearly as much as I'd like to go to LOI, let alone their assistance to bypass LOI and go right to APA. That being said,
let's talk about that though.
Yeah,
let's stop right there.
Yeah.
So we had some pretty long and decent discussions about skipping LOI and going straight to APA.
Yep.
Brokers, lawyers, I'm sure the industry is mostly fine with it. But yeah, I mean, tell me your viewpoint on that, because I know you had a decent feeling in a certain direction.
Yeah, listen, I get it, and I totally understand the perspective of don't do it. It's bad to go. And there's parts of me that, again, do not disagree with that. That being said, it's difficult because I know the real estate transaction perspective so well. And I mean, again, there's tons of nuances and differences here, but we've gone through a transaction before and we many times, and we know what that flow looks like. And the fact that we do have an out, we have 30 days of due diligence to pull the plug. We're not the type to fall asleep at the wheel and not be tracking our dates for those types of things. And, if you look at a lot of these LOIs for business acquisitions, so much is contingent. I mean, everything is subject to change based on what you find in due diligence, that you're really submitting an LOI to kind of hash out these main deal points. And the narrative, even though we didn't have a ton of info behind this deal, the numbers were good enough and the narrative behind it made us confident enough. And it was listed for $500K, which was the bottom end of our price range. So we said, we'll get in a offer $100K over asking price for $600. Since they had a buyer flake out on them before, couldn't get the escrow money, they wanted to go directly to APA. We talked about it, understand the hesitation there, but we said we've already ironed out the purchase price. Now that's kind of the biggest thing for LOIs. We've already submitted that. So
yeah, you've already put yourself in a position where you are in the leg down paying more than asking. So there really is no renegotiation there. But for our listeners, so what happened with Chris is he normally or traditionally in the field, right? You get the CIM, you fill out an NDA, you get the CIM, you go through the CIM, it has basic financials, you meet with the seller, you talk with the seller, you decide, hey, is this good business, bad business? You ask them questions, they come back with answers, you ask them more questions, they come back with answers. Then you have the general basic on financials, you maybe even get some of their tax returns like that, and then the next step is you go into LOI. You go into LOI, that's where you start breaking open their books. They give you access to their QuickBooks or to your accountant can go look into their books and do a quality of earnings and see, hey, is this business, you say they made $500,000 this year, but was that $500,000 from one job? Was that job really even a plumbing route job? So there's like a lot of quality of earnings really is a quality revenue that's coming in versus, hey, this guy's paying me under the table over here and this guy's doing this weird thing over there. So it can get, especially with the with issues in like how you're evaluating the business. If you're evaluating it off of a multiple, like every dollar is worth $3 to $4, right? At a 3 or 4x. Yeah. So it can be in the seller's best interest to kind of get a little weird with money. Not saying that they're bad people, just saying, hey, they might have counted something or forgot about something else that maybe shouldn't have been in there.
Yeah.
Long story short, after you finish that, you go into the APA. Like, hey, I'm ready to buy. You either retrade it after LOI. You say, hey, I believe it's worth this. Here's what we're going to, or hey, we're not changing anything. Your books are great. They're super clean. Here's the offer, which is the APA, which stands for the Asset Purchase Agreement, right? And so you go to a lawyer, you talk to a lawyer, the lawyer helps you build the APA, it costs some money, and then you submit it, and then boom, you're off to the races. They accept it, and then you start with banks. So what this seller specifically wanted to do is they wanted to skip the whole LOI phase and go straight to APA, which in itself is not inherently bad, right? They've already figured out price point. He hasn't looked at the books yet, but right, they're asking over asking price. So as long as the books come out somewhat clean in due diligence, like there's no retrade available. Where Chris and I had a long discussion over a course of a couple of days was, yes, there's nothing wrong with going straight to APA, especially in his specific situation. That being said, it's not something that I generally recommend. And I don't generally recommend this from a 32,000 foot framework level because it puts you, the buyer, in a poorer seat to renegotiate. So you're spending money up front, you're putting down earnest money. So now you have money tied in. It's not locked up, right? You could cancel out, you get it back. You put some really good clauses in there that says, hey, I got 30 days of due diligence to decide. I've seen it where buyers have forgotten and gone over that 30 days and still don't want the deal and then have to back out and lose their money anyway. We're gonna ignore that little fact there. But what I will say is it puts you in a position where you're spending money up front to work with a lawyer and to get the deal ironed out, but you haven't actually seen the financials in depth. And so it puts you in kind of a worse spot, non-optimal spot for having these talks with the seller. And so that's my belief in the framework is you want to come into this, as Chris said, extremely loose on don't get me wrong, you want a solid LOI, you want to have a solid idea of where the price is going to come in. You don't want to really retrade. I'm not saying that, but what I'm saying is you don't want to start off in a bad position where the seller is at an advantage because you've had to put all this upfront money and lock yourself into a deal that maybe you find some skeletons. So that's all my point is when you go straight to APA, you're in a disadvantageous position from the gate versus when you go into an LOI, it's very loose. And that's why his seller didn't like it because it's putting him in kind of a negative his seller wanted him to be in an APA so that he viewed him as a real buyer.
Yeah.
So it's this balancing act that you have to do. It's not my personal favorite way to start off a relationship with a seller. I would like it to be a 50-50. Nobody's at a disadvantageous split. It's just, hey, we're going to go into this, figure this out. We're going to do the due diligence. We're going to understand your business more. And if it is weird, we are going to retrade. And I don't have any capital up front that I've locked in to this deal.
Yeah.
So,
and it's beauty is in the eye of the beholder. And it's kind of one of these things where, again, retrade probably wasn't going to happen because we kind of already locked in our purchase price and really just confirming that the numbers are what we think they are. We still have our outs. And the real key I found is LOI straight to APA, regardless, when you're going through that CIM process that you reviewed, you're working off such limited information. You really don't know much until you get a due diligence and get access to all of their books, get access to all their financials and their numbers. So it's really just kind of, all right, well, what's going to get us there? And if we got to spend a couple of attorney dollars, even if they go out the window, which they did, really wasn't the end of the world.
So, but that's for you, right?
Yes.
So like your situation is specific to you in that that was worth it as a risk for you to waste that.
Yeah.
I know for me personally, I wouldn't have done that. I would have said, hey, I'm not going to do it just because I don't want to pay. I mean, an APA can cost a really good APA that you do correctly could cost, $5,000 more.
This was much skimpier than that. It was pretty bare bones, simple APA. So again,
especially if you're working with the SBA and stuff, they have a bunch of requirements that has to, I know you're not specifically, but if you're working with the SBA, like there's a lot of kind of terminology and paperwork that they need.
Yeah.
And so, long story short, I mean, it didn't work out though. Somebody else came and stole it out from under you in the interim. That was
the weird part. And I'm chalking it up. And I shouldn't even say I'm chalking it up. I'm pretty confident that it was fairly shady broker activities because what happened is we got an LOI for 100K over. They said, let's go straight to APA. We said, fine. I get the APA on Easter Sunday. We turn them comments around by Tuesday at 9 a.m. So very reasonable time.
48 hours, yeah.
Yeah. And so then I'm pressing my broker, what's the word on this thing? He finally gets in touch with the broker, I think Thursday. And it's oh, sorry, another buyer came along and they ended up taking that offer. And so, I'm like, well, we came in 100K over, got you comments turned around like that. that doesn't add up. And what we're assuming is that the broker found his own buyer, and so he was going to get dealt to
Allegedly.
Yeah.
Allegedly. Jackquisitions and myself do not believe any of this at any point.
Allegedly.
Yeah, right.
My assumption based on what I'm hearing is that the broker found a buyer and bailed on his fiduciary duty to his client and, wants to double dip on commission. So that's kind of what I'm assuming from the facts I know, allegedly, but so, this one obviously was in our hands, out of our hands, back in our hands, out of our hands. I'm fine with it being to the winds. And we ended up finding, a great replacement in the pipeline that I'm very, very excited about. So
let's talk about that one from the beginning, because I have some huge comments on this, but where did you get this last deal? What is it? And I'm calling it the last deal, but like where did this come from?
I know,
and how
I gotta be careful. I don't want to fall in love too fast,
right?
But I'm also kind of viewing it that way, even though I shouldn't. But the sourcing story was really fun. So I took the advice from this podcast. I went and hired some freelance contractor on Upwork, and I said, here are my parameters. Go find me every painting and pressure washing business in this geographic area. I gave them some other criteria to hit to make sure I wasn't, swinging at either the top end or the bottom of the barrel. Their work was but it was good enough to really kind of get me off and running with some cold calls. Like, I think 3 days in, I called up this pressure washing business, and he kind of sussed me out at first. He's like, "Are you a broker? Like, what's your deal?" Once we established some rapport, he's like, "Well, we're actually listed for sale," which is why I was asking. I was like, "Dude, no way." And he's like, "Well, we were just tied up for like 5-6 months of due diligence, and our buyer just bailed and retraded us away from Sunday. So, we're about to list it back on the market, but not for another week or so." So I'm like, "Perfect. I get first crack at this thing." And actually, it's funny, the listing broker was one of the first brokers I reached out to in my search process, fellow Marine vet. I have a good relationship with the listing broker as well, really just by chance. Although now that I'm thinking about it, I don't know why he didn't hit me up.
See, that's what I said, though. Like from the beginning is the brokers have so many people in their queue. If you don't stand out like a big sore thumb, they're not going to remember you.
Which is weird.
They might, but it's a lot, right? They have a lot of people.
Glitter at my own skirt here, but I thought that he would remember me because we had such a nice warm relationship. I would check in with him at least every other week. So I thought I was a standout, but apparently not. But regardless, we got in front of the deal early, which was great. Couldn't have had a more warm and enjoyable intro and start a relationship with these sellers. They're tatted New Jersey guys, just kind of like my sort of folk, are really, really down to earth, fun to speak with, family oriented business as well. So sat down, spoke with them, and they were even gracious enough to keep it off the market until we were able to get a chance to sit down and meet, which again, it just felt like the rapport established there was fantastic. So just got their LOI in today at noon. So we've been running a comb through, the 4 years of, cash flow statements that we have. But
so what's the timeline that took you? Like, what was the process? Did you reached out to them, got a hold of them? Mm-hmm. Did in person? Did you do a second in person or just a single in person?
In person. I reached out to them probably on I think a Tuesday-ish or a Wednesday. Sat down with them that Friday, knowing that the listing was going to go back on the market sometime late the following week. So I knew I had 1 week to analyze things. And it's attractive. There's a lot of things I really do like about it, but there's not a lot. There's some volatility in the SD, and then some of the add backs and some of the way that they're categorizing, COGS, expenses, and all that. It was a little bit whack. So it definitely took a lot more diligence and weeding through and getting confident about what exactly I'm looking about here. And then engaged a valuations expert in his office. So had some boots in the ground and was very in touch with the seller. I was like, listen, I do not want to get beat to the punch on another deal. But they were very, very open and honest, saying, hey, listen, it just went back on the market a couple of days ago. No one's sniffing around yet. You've got a few days. We will absolutely keep in contact with you. Should we get another offer so you have a chance to counter? So again, the relationship established went a long ways.
That's huge. And then what also that I hear is huge is you have a team already pre-prepared behind you, right? Like that's huge in itself that, you had somebody to go to for some easy due diligence. You have somebody already to go to for some legal work. And so I think that's an important thing that we kind of gloss over is this has been a really fast process for you, but you've also built a team in the background that has been able to really support, you getting that week-long period and figuring it out and going to there because, hey, I know this valuation expert, boom, done. Like now we have a valuation. I know where I can offer in at. So that's huge as well. So I think a big shout out to you to actually being somebody who is ready to go and who has everybody in place to actually be real. And I think that's something that, goes a long way. And so let's talk some light numbers. Cause I know like you probably don't want to talk the, exacts, but you said there's some wonkiness in there. Can you go ballpark on, so it's pressure washing and painting. What's the side?
Just
pressure washing?
Yep.
Oh my goodness. And what's the gross and the purchase price?
Yeah. So purchase price, they're asking like 1.5-ish, which is right at the top of my end. But since like episode 1, I mentioned power washing. I felt really confident.
That's what I'm pumped about, man.
Yeah, especially down here in South Florida. I mean, you can do it year round. There's really no lull periods. And I got some notes from someone in your network about pressure washing, and I understood a lot of the grievances, and the hangups surrounding that sector. But there's going to be hangups in any sector, and it's kind of how you manage it. And my whole thing was I wanted something that was commercial, business to business oriented, and they specialize in commercial and governmental properties as well as multifamilies. They are doing some rolling, or actually, I got to hold myself on that one. But bottom line is they work with people and they recommend not seeking out residential. And they don't necessarily avoid it and they won't say no to it. But the fact that that's not their focus was a huge, huge plus for me. So it checked a lot of boxes to make it worth taking a run at, even though it's on the higher end of my.
I just love that it came in I remember day one, conversation one. It was like, I asked you, what is your dream business? You said pressure washing, B2B. And like we're sitting here with a pressure washing B2B company that seems to be a good fit. So they came in at 1.5. What was their top line revenue? And then what did you end up offering them? I don't want to get too in the weeds in that. Yeah. But like,
so their revenue over like a 4-year average is like right around like 1.7 million. So,
which is amazing for a pressure washing company. That's very good.
They're doing some serious numbers. And gross margins are like very, very steady Eddie, no more than like a 5% swing in either direction, kind of right where they should be. SD was a little up and down again due to some very bizarre expenses that are very, very controllable. Like there was nothing at like, it's all kind of, we've stuck a bunch of red flags. They're like, all right, this needs to get hashed out due diligence, like what the heck's going on here? But it all seems things that are very, very controllable, like nothing that's it's not a material cost or thing that's going to run away from me.
So with that being said, right, the way that you mitigate risk in these acquisition deals is there's 2 ways to mitigate risk: due diligence and price.
Yep.
So what are you doing? Like that's the framework, right? Because if on the extremes, right, if they sold this to you for $1 as an asset sale, right, the price is so low that the risk doesn't matter. It doesn't matter that they've been, their books are like ugly. It doesn't matter that the owner is an asshole. Like it doesn't matter if they sell it for you cheap enough.
Oh, I'm taking a swing here. This is a big book for me. Yeah.
Yeah, but on the other end, right, due diligence of like actually going through their books really in depth and paying for good QOV and making sure that they're being honest. So how are you looking at this as you start moving into, hopefully they sign the LOI, but like what's the purchase price? And that's why I'm bringing up, this whole thing. How are you viewing that? Are you getting creative?
Yeah, absolutely. We've gotten very creative. I'm excited to tell you a bit more about that. And one quick note on due diligence, since we can simply breeze by it. Yeah, we've got a very, very thorough list and a very, very good accountant. And we're basically telling him this is not quite forensic accounting, but about as close as you can get to that as we possibly can. So again, we've got
Is he experienced with QOE though?
Yes, he is, and he's with that's not bound by any. It's Kemper CPA. They're a top 100 accounting firm in the nation. Like, yeah, they've got enough resources there where I feel very, very confident in them kind of handling the due diligence process. So and that's just something we are very anal about in general. So yeah, all numbers will be gone through with in contracts, et cetera, et cetera. So we're very granular on DD. So getting to risk mitigation, we're all pretty in alignment there. As far as purchase price goes, yeah, their multiple was right around like just shy of a 3. And from my research, a pressure washing biz trades around like 1.5 to 3x. They've got a lot going for it, so I can't ever reasonably say it's below a 2, but due to some of these accounting practices that we saw, I don't know if it's really on the high end of the spectrum either. So we came down to, we're going to try to end up at a target purchase price of 1.2. And then I am doing, I'm hoping there's post-production where I can go and take out some of these numbers if I'm getting myself in trouble, but we're offering. Can I say how much we're offering at close?
Yes, there's nothing that should be in an NDA that would say what you're offering.
Otherwise, I have confidentiality clause in them. So I'm not violating.
I think we're good on that one. But yeah, like how does that 1.2 coming out at? Because the creativity aspects is what I always love.
Yeah, that's the fun part. We're doing 900K at close, and I know that you had and then we're doing the rest of it at an earnout. And I know that we had a talk about earnouts, and I gave you my idea for an earnout, and you said, "Yeah, good effing luck, dude." And so
did you say yes?
That's what we submitted, yeah. And so, but the thing is, it's not necessarily just about because what Jack and I were to the audience.
We were
so. Yeah, we can get into the structure of that. We're asking that.
Yeah, let's just start with what you offered first.
Yeah.
So you left 25% as a seller finance note of some sort, and you're structuring it as an earnout.
Yep.
Which for everyone listening who doesn't know, that means that certain goals need to be met to get the last evaluation. Yep. What I told Chris is always recommend a seller note, because on the first side of it, right? If you need the seller to do something, it incentivizes them. Mm-hmm. So in this case, an earnout, a traditional earnout, we'll talk about your special earnout here, is usually a private equity firm comes in, buys a company, wants to keep the owner on, says, "Hey owner, if you grow the company 20% in the next 3 years, we'll give you, the last bit of this purchase price. We'll give you the last 300,000. So that's the earnout structure in super simple terms. It's great. Once again, it's incentivizing the owner to stay on and to continue working hard. And that's generally the structure of an earnout, but you also should do seller financing, because for indemnity and other kind of legal reasons, it's the first place you pull from if the seller doesn't do what he says he's supposed to do, right? So if you have in the clause that all vehicles will be working day one, and then you get there and 3 of the vehicles are down, it's very difficult to go to a seller and say, "Hey, 3 of these vehicles are down. It's going to cost me $20,000 to get back up. I need a check for $20,000. The seller's going to go kick rocks, see me in court. You're closed. But what is much easier to do is say, "Hey, we are going to deduct $20,000 from the seller note. So now you don't owe me $300. I owe you $280 in that example." So that it's a great tool, and it's also like a protection mechanism to make sure that the seller is going to do what they say they're going to do. Probably one of the most important decisions you can make in your ETA journey is which SBA lender you are going to pick. A lender who will be in your corner to get you closed on the deal, as well as set you up for future expansion. That is why we partnered with Alan Peterson from First Internet Bank. He and his team take a "how can we" approach, as well as I personally know they specialize in home service acquisitions. Mention the show or my handsome bald head and receive a reduced good faith deposit, as well as a detailed deal review and maybe even a buy-side pre-qualification. No strings attached. Head on over to alanfib.com. That's ALANFIB.com entrepreneurship.com or click the link below to get connected. But you came to me with this wacky idea. I love it.
And
I yelled
I
that
don't know
this
how
is
wacky it is because again, we're totally new to this deal structure. And once you explain why it's wacky, I agree with you. And
I love it.
What we're doing essentially reflects a seller note. But the thing you also get with the seller note is they're going to have their own interest rate attached to it. So, I didn't like that. I'm already paying interest to the bank for this thing. I didn't want to pay more interest. So my whole thing was, we talked about this a little bit last time. Simple man, simple needs. My income needs are not, I'm a cockroach. I'm used to living in bushes and shit. Like I can live on very, very little. So I said, listen, I'll cap my income off this, and there is a healthy margin on top of it. But I said, I'll cap my income at a few $100K. And
so for everyone listening, a few $100K generally isn't cockroach level living, but I'm just gonna let that pass by.
And for me, I went into this process expecting, I was like, if I can just make, because I was in sales where there was the classic low base and they said commissions, but deals wouldn't come. And so I'm like used to living on like less than 100. So I'm like, if I can just get to 2, I feel like I got more money than Davy Crockett. So this thing absolutely had buffer for a few $100,000 and then some on top. So I said, listen, I'll cap my income at a very, very safe level. And which again, is way more than I feel like I could ever spend in a year, but I'll cap my income here. Any overages, and according to the numbers I'm seeing, there should be plenty of overages. Any overages go to you, the seller, until we hit this eventual 1.2 purchase price. And to kind of sweeten, because you point out, you're like, yeah.
As what? As like a percentage of revenue, or as just like overages, like anything comes off
the bottom line. My income is capped at, at a few $100K. Any overages in discretionary earnings go right to you as the seller for a span of 3 years until you hit your eventual purchase price capped at 1.2. And you pointed out they're not going to like that because any overages, you could shuffle them around in a lot of different ways to hide that, or not even being shady about it. You could just reinvest into equipment, into advertising, and all these things for growth. And so to mitigate that, I said, hey, listen, we'll do quarterly reviews of our books. Again, we use a top 10 CPA from all the cutting to avoid taxes that you guys have done. Our accountant won't do that. Like we just don't do things that way. So you'll get, quarterly reviews of the books, and we'll put a 10% variance cap on expenses. Basically, we just want to run it the way that you guys have.
Okay, so you're going to run it exactly the way that they're going to run it.
Yep.
10% cap on your salary. And then what you're saying is that anything from a net cash flow earning at the end of the year in the bank, you're just going to redirect that to their account until they reach that last 300,000. It sounds like.
Yep.
Sweet.
Yeah. So because my whole thing is like, man, I'm not trying to burn you. I just don't want to get my buns whacked if I pay close to $1 million up front at close for this thing, and all of a sudden it's not earning. I'm trying to avoid that, and I want to get you to your. But honestly, and they could make the.
Did you put a time frame on that as well?
Yeah, I said 3 years. If they want to push it back and make it 5, I'm honestly fine with that. Or if they want to up the purchase price, I'm fine with that. The total purchase price, I'm fine with that too. Because if I can cover my nut and make a few $100,000, which is again more than I ever expected to make, and then they just got to take the overages to make them happy. And if that makes both of us happy and makes me feel safe and gets them to their purchase price, that makes sense to me, So anyways, that's what we're
not my favorite structure. And I'm going to tell you why. Yeah, it's okay. I mean, it works for you, like you said.
Yeah.
At the end of the day, and I will reiterate this 1,000 times, it's everybody has different life goals. And so you're buying and building a business, or you're growing your business based on your life goals. And there's definitely ways that you can optimize for other things, but to say that you're wrong in the way you're doing it is never what I will do.
You can.
No, it's not, because if your goal, if your goal is, hey, I want to make $200,000 a year, run this business, start putting away, equity, paying off the equity of this business through my debt service. Mm-hmm. And that's all I want for 5 years. Like, I don't want to grow this thing. I don't want to do anything else. I just want that. Then this is a great lifestyle business for you. What I will say is, if you ever want to grow, and there's reasons to grow, right? There's reasons to grow outside of like, hey, I just want to make money. The reasons to grow are yeah, you do just want to make money. The other reason to grow, which is the one that I'm actually worried about for you personally, is because it happened to me, right? This is my story, and that's why I'm sharing, is you can grow out of the debt burden, right? So when I started and we were 700,000, like the debt burden of making $10,000 a month was like, oh my God, how the heck do we hit 10,000? Then as we, crest 5 million, I don't think about it. Like, it's not something that I ever think about because the debt, like, it's something that we have to pay every month. Yeah. But that 10,000 is such a smaller portion of our total revenue or our total expenses that it's not even a big deal anymore. So that's the only part I worry about this for people listening and want to copy is like, make sure if you decide you don't want to grow, that's okay. But just watch the debt burden on the business because that is not something you'll be able to grow out of. And so what I said to Chris in the beginning, so that's the only part that worries me. But otherwise, I'm like, this deal is crazy if it goes through because what I was telling him was, I said, there's no risk mitigation for the seller, right? You could dump it. Originally, it didn't have all these caveats on it of the 10% on
where I got those ideas
expenses, and cap on your salary, because he originally came to me and said, hey, Jack, like, I just want to do it, shovel everything off the top that we don't spend to them. And I said, that's great. But if you try to grow the business, you could take that 400,000 and you could dump it back into growth. You could dump it into marketing. You could dump it into new vehicles. You could dump it into wherever you want. And the seller would just get zero every year, 0, 0, 0. You could raise your salary. You could raise it up to, 400,000 if that's the number. And you could scrape off that 400,000 so that you're paying them zero. So they either have to really trust you as a person to not do that, or you have to put caveats in like you did. A 10% variance, it sounds like it's a fair amount. It actually does still give you some room for growth too. It's like, hey, we can bump marketing 10%. If you're already spending, the max on marketing, like that'll give you plenty of room to build and grow. But I mean, it does still hurts things like vehicle purchases and really adding new headcount.
And it's also with prior approval, if we need to go down and say, hey, listen, like we're gonna spend more than 10% of a variance on some new equipment. I'm not going on like a handshake deal here, but we can build in some contingencies to account for things like that. And back to the whole point about growth. Again, I'm not saying I'm anti-growth. And again, I got to be careful about certain aspects of the deal. They're very growth oriented that I don't want to, make a boo-boo and expose. But, let's talk about growth for a second. Because again, I'm not anti-growth. And what's our timeline? We're coming out of the gate on 3 years. And as I said, would I be fine with more than that? Sure. But we're looking at that earnout structure taking place over a 3-year cap. And honestly, as someone who's new to owning their own business, in the first 3 years, and again, not that I'm anti-growth, but my focus is not on that out of the gate. My focus is on establishing myself as an operator, understanding the business, really, really getting my arms around it. And then at the end of those 3 years, then I feel like I'm comfortable, I'm in the saddle, and then I can really, really prioritize growth. So
it's definitely not a lifetime. 3 years isn't terrible, but you are talking to someone who has owned a business for 3 years and grew it from,
it can be done. Obviously,
500x.
The proof is in the flesh, man. Like you've done it.
0 employees to now like 24 employees. So like that's my point is I think you will wrap your fingers around this business, a lot faster than you think you will. 6 months rolls around, a year rolls around, you'd be like, okay, I kind of get this. Yeah. And you hire a good manager, like, okay, he gets this and I get this. Now we're putting some fire behind it.
And if I got to spend 24 months kind of sitting there, at the gate, kind of itching to go, like a lab,
it's not the worst thing in the world.
Season just kind of pulling away. If I gotta do that for 2 years in exchange for giving myself some serious risk mitigation, done deal. That to me is very, very worth it because I'm getting a much, much more tolerable purchase price that I can finance through the bank. I'm on the hook for less. Again, they still get to their purchase price. It's just with bottom line earnings that's just kind of surplus. And I'm able to lock it in at a price at closing that's much, much more palatable to me. So if that's my trade-off, then I'm again, I come talk to me in 3 years, I could be singing a very different tune, but as of right now, it seems like a very worthwhile trade-off. So that's kind of what our logic was that got us there.
So here's my other question, which is what I've already fed to you, is why not revenue share agreement? So hear me out. I mean, if they say no to this, you know, you can always go back to the table and redraw, but why not revenue share agreement? So I just did the math on 1.7 million. If you were to do a 5% rev share agreement, right, which it seems like you have available, that is $85,000 a year for 5 years would be 4.25. So they have an upside. I actually wouldn't give them that much upside. I would do 4 years or something. So, and then, so they have some upside. You have some protection. You could actually honestly pay that off in less than 4 years, right? If you grow the business, but it at least gives you it takes away any kind of handcuffs that you have on you, right? I just don't like handcuffs in the sense that, you know, I've said this before. I believe that people get into ETA for 2 reasons. One is they don't like being told what to do. And 2, they're born into it. Their parents did it. Their uncles did it. And so I don't like being told what to do. So like handcuffs would drive me nuts. It'd be like, I can't do that because I have a cap. So, but like a rev share, like if you win, they win. And so it's also aligns incentives. So they want to help you grow, right? Because if you win, then they win. They get a revenue share. They get to their goal quicker.
Yeah.
So always an option. And at, you know, 85 a year, the SD could easily eat that. You're going to probably shuffle that off anyway.
Yeah.
And if you get like a massive down year where like you just get absolutely stomped on, you know, that drops. Like the burden for you is less, just because your revenue is less.
So. Yeah. And my kind of thinking there was I just felt a little bit more exposed having to come off the top line rather than the bottom line. Because, you know, for example, I'm creating a bit of a ridiculous scenario here, but chemical costs for pressure cleaning, whatever, tariffs, let's say that everything takes a massive expense hike. Okay, well, my revenue might have shot up or something like that.
Good thing. I'm telling you right now. Well, that's because that's where I think that you're misviewing this is It's not an expense item. So rev share you shouldn't be looking at the expense section to look at rev share agreements. You look at the gross section.
Yeah, I'm aware of that. I think
gross margin is where you look to make sure health of the business.
Yeah, I might be miscommunicating. And so when it comes off of the top line, when it comes off of my revenue, yeah, that's great, you know, but now I am beholden to paying them a number off of my revenue, off of my top line, when I have no idea what's going to happen with expenses that's out of my control moving forward. For example, if I owe them a portion of my top line, if it performed at X according to the agreement, and now I owe them a portion of my top line, well, shit, doesn't chemical costs due to tariffs, labor costs, whatever, took a massive hike on my expense end, and now I'm having trouble covering my expense end because I had to give away part of my top line to them via this agreement. And that left me feeling exposed. Sorry, I have cleaners now coming in. It's really frustrating. Sorry about that. Yeah, so that was why rev share kind of turned me off a little bit, was because it felt.
Yes, there's potential for bigger downside, but there's also like, that's all mitigatable, right? So I see what you're saying.
Yeah.
That being said, I mean, it's your choice, right? Handcuffs versus for less downside risk for 3 years.
Done.
Versus, hey, I have as much growth potential as I want, but I have 0 handcuffs. Because at the end of the day, right, it's a gross margin game. Because realistically, right, expenses go up. You don't just eat expenses. You raise your price to match the rate of your expense increase. Just like we see, technically, right, if it's chemical, it would be a COGS. Just like labor, your labor goes up, same with COGS.
Yeah.
And so to keep that gross margin the same, you would raise your prices to mitigate for the increase in COGS. Yeah. And that would make it so that it actually doesn't matter, because even if price goes up, or if cost of goods goes up, price should go up. The only downside is like if your team is not great at selling at the new price, then you have potential for less revenue.
Now I'm fundamentally changing aspects of the business which have been successful for a long time. So I think that I love how you kind of broke it down to bare bones of like, all right, you can either have handcuffs and protect yourself against more downside, or you can incur a bit of mitigatable downside for unlimited growth potential. I'm like, I'll take option one all day, twice on Sunday. I
Well,
mean, and that's just the way we operate. Again, we are, I said, again, Marine Corps, boxing, jiu-jitsu, surfing. I got a lot of risk tolerance on my physical body, but my deal-making risk tolerance is very, very low. Like we are very risk averse in that perspective. So if that comes along with some handcuffs, and again, if it's for a time window of 3 years and the handcuffs to me feel tolerable and negligible, fine with it. I would much rather do that and feel some protection against the downside, than have a sexy growth opportunity.
Sweet.
So that's just me.
Well, clip that, because we will come back to this whole conversation later, I'm sure.
Yes, we will.
I love it. No, this is the coolest part about ETA is that there's 1,000 ways to skin this cat, and realistically, the creative portion is up to you and the seller. You can come up with any kind of weird and wacky things you want, and the seller can say yes or no, and they can kick you out of the office, or they can say yes. And so I don't think this is wacky anymore as it was when we were just like, hey, zero, no, like they have to just trust me. I'm like, they're not going to just trust you, buddy. But that being said, I think that you've generated it into something that's manageable. Yeah. So I'm excited to see. And so we'll hear from you on next week's podcast about which way this went. And I'm sure there's probably gonna be 1 or 2 iterations of notes, and then we'll get to like final details, which will be cool.
Yep.
Sweet.
Absolutely.
Well, thank you all for listening. If you like what you heard, leave us a 5-star review so that my mom feels that I'm doing something fun and cool with my life, and to give Chris confidence to make some awesome deals. And go ahead and share, whatever. Come and visit us at ownedandoperated.com for some more information. Appreciate it, everyone.